I welcome you all to Month 3, Module 4. So today we're talking about kill zones. The algorithm is all about time and price. Price is programmed to move most at selected windows of time. Knowing and understanding this will improve your precision in trade entry and reading price action. So there's something called time and price theory. In as much as we understand price action, we want to blend it with time. When you look at your chart, you have price at the vertical end, either at the right or left, whichever settings you choose. And then you have time at the horizontal end, below the market. So now you want to blend these two in order to give you precision in your analysis. When we speak about the algo, we include time. The algo works with time. The algo doesn't just work randomly, it works with time. So you knowing these time windows and the character at which price display in these time windows will give you precision in your trading. So here's an illustration. So this blue line here represents a higher time frame, and then this black line here represents a lower time frame. So you can see in a higher time frame, the swing is usually smooth. But when you come down to a lower time frame, you will see this noise, this small movement here, these swings. So now once price hits a key support level that is in the higher time frame, you want to come to a lower time frame and then refine your trade to be taken in a specified time window. And these time windows are called kill zones. So we are pairing price and time in order to give us precision in taking trades. So I'm going to be giving you the types of kill zones we have. ICT kill zones. It is the area in time for an expected maximum move in price. It is a period of time prior and into the trading sessions. Expect a protraction against the intended price move. So these kill zones are where you expect maximum price moves, are where you expect manipulation, like we see here, you expect a protraction against the intended price move. So you don't just enter the market anytime. You want to be timing your trades in this time windows. You want to be executing your trade setups in this area of time. Now, there are 4 types of ICT kill zones. We have the Asian Killzone, the London Killzone, the New York Killzone, and then the London Close Killzone. And these Killzones are period and into the trading sessions. You know, we have the Asian trading session, we have the London trading session, and we have the New York trading session. So these Killzones are before the trading sessions, and then they elapse with the trading sessions. So we're going to be seeing how this happens. So we have the ICT Asian Killzone. Like I said before, I want you to set your chart that's in your trading view, your trading platform. If you set it to the New York time, if you go to settings, you see it there. So now we can see here that the Asian session is 7 p.m. to 4 a.m. instant time. That is the New York time. The Asian Open, that is the Asian Kill Zone, is 8 p.m. to 12 a.m. That is the instant time. That is the New York time. Now we can see here that Asian Kill Zone is into the Asian session, like we said in the previous slide. So you can see 8 a.m. to 12, while the Asian session starts 7. So this 4-hour period into the Asian session is the Asian Kill Zone. Now this Kill Zone is very, very important, like I explained prior to this slide. It is a time where you expect the maximum move. It is a time where you expect the protraction. Like I remember I taught you protraction, that is the move against the intended move. And then again, it's a time window for precision trade taking. This is where you can take your trade. So this time window is not just random. We didn't just select a 4-hour period within the Asian session and then call it the Asian Killzone. No, this is a time window we've seen a characteristics of price played by the algorithm on a particular area of time. So I just hope you understand. The Australian dollar, the New Zealand dollar, Japanese yen pairs are ideal to trade in this time window. Now you can remember when I explained in the beginner videos, that's month one, where I said we have the Asian session in London and then in New York, and then there are certain pairs you should trade. But now again, we are seeing that the Asian Killzone has been further refined into a 4-hour period in the Asian session, but it still applies with the pairs that you can trade for this time period. And I explained why you can trade them in this time period, because in that country, that is when transaction begins. That's when banks open that time, because all places in the world do not have the same time. Like now it can be 6 p.m. in Nigeria and then 12 p.m. in the US. The time is not the same. So we could expect different currencies to trade differently in different time windows. These currencies are controlled by the country's banks, the country's economy. Higher time frame bias is helpful here. Usually, the high or low of the day is formed in the Asian session. The period when the market is not willing to run in this session, you will see a consolidation until 12 a.m. Eastern Time. This consolidation gives many clues of how the daily range will turn out for the 24-hour trading day. So the Asian session also gives an idea for other pairs, like we have the Euro USD, British Pound USD, we have the USD Yen. So the Asian Killzone does not just give you a time period for you to take ideal trades, it also helps tell a story for the trading day. So once it ranges, like I said before, you want to see the market range first. And when you see that range, you expect an expansion. And this expansion will probably be in the London Killzone or in the New York Killzone. So if you see a range, you know the market is building up orders above and below the market. So you want to expect that the next trading session or the next Killzone, which is the London or the New York, will set an ideal platform for a profitable trade. Crosses or the pairs that do not have USD in it are most active this time of the day, like the Euro Yen, British Pound Yen, CAD Yen, Australian Dollar CAD. So these pairs that do not have the USD are the ideal pairs to trade for this time window. The USD tends to consolidate until 12 a.m. Eastern Time, which frees these crosses, that is, the busy crosses of this time of the day. So if you are a cross trader, this is your time of day for trade setups. So if you're someone that trade the crosses, so this is a period you should be entering the market. Either you are swing trading, position trading, short-term trading, day trading, or scalping. I'm going to show you how you're going to be using the Asian Q zones, London Q, how you can pair it with your style of trading. So here's an example. This area here represents the Asian Q zone. Like I said before, this area is where you see maximum move of price. Look at how price was quiet period to this area here. And then I also said you should expect a protraction against the intended move. So look how market protracted. So a trader who may not be aware of Q zones, who trades at any point in time, might take a trade here after getting a very good bias that the market will sell. But unknowingly to this trader, there is always a protraction against intended move. So this person will be taken out because stops are resting above these highs. So I said before, there's always a protraction in this area. This is where you will expect to take a trade after you see a protraction before you take a trade. And look at how market ride down beautifully. And secondly, we have the ICT London Killzone. London session, we all know it is 2 a.m. to 11 a.m. But London Killzone, which is London Open, we have the 2 a.m. to 5 a.m. It's another brief hour into the London session. So we as the smart money traders, we don't wait to take trade throughout the London session. No. The London session is what gives momentum to our trades. We enter at the beginning of the London session. This is when the London session begins. So we wait for this time window. We don't want to take trades outside this time window that we see here. We want to take trade within this time window and then let the trade ride for the remaining session. So the Euro and the British Pound pairs are ideal to trade in this time window. Why? Because these are European pairs. Although that London session is when these countries begin transaction. So of course you should expect liquidity this time window. So higher time frame bias is helpful here. Again, most likely the high or low of the day is formed in the London session. Now you can see that in the previous session we said the high and low is formed in the Asian session. This saying only applies to the ideal pairs to be traded. But for the pairs to be traded here, which is the Euro and British Pound, the high and lows are usually formed in this session. Our London session offers about 25 to 50 pips, and the London session sees the highest volume of order execution than any other trading session. So here's an example. We can see how market rallied downwards. So at this point, market became very, very quiet. This line depicts the 12 a.m. midnight New York time. So you can see this protraction taking out liquidity before rallying upwards. So you want to wait for this time window. So you could see if you mark out from this point to this point here, it will give you the London session. But the Q zone is just those few hours into the London trading session. So this is where you want to be buying and expect a protraction against the intended move. So here's another good example. You can see this line here represents the 12 a.m. midnight New York time. You can see how market was very quiet. So look at market consolidation, retraced, market consolidation, rally downwards, and then begin to range, very quiet. So you can see how market protracted this move to take out liquidity before rallying upwards. The same thing here. There's a 12 a.m. midnight New York time. Market protracted to take out liquidity below the market, below these lows, before rallying upwards. Then the third, ICT New York Killzone. And the New York session is 8 a.m. to 5 p.m. And then the New York Killzone, that is the New York Open, is 7 a.m. to 9 a.m. Eastern time. So this is into the New York session. Major pairs are ideal to trade in this time window. Higher time frame bias is helpful here once again. And New York session offers about 20 to 30 pips. Every pair doesn't have a setup on every New York Open, but New York Open has a setup in one or more of major pairs. I hope you understand this. So you kind of expect that only Euro USD, you should see a setup in the New York. Sometimes you may not see a setup in the New York. Where you see setup will be in the London session. But if you don't find a setup in the New York, in the Euro USD, expect that in the New York Q zone, there will be a setup in another pair. So you can't find a setup in one particular pair every single time in the New York Q zone, but you always find a setup in the New York Q zone in one or more of the other major pairs. So if you look through, you will see a setup. This session shows a consistency of economic news release. So one of the drivers of this move in this Q zone was the news release. Majority of the news releases are the 8:30 New York time. So this time period, you will expect liquidity. The New York has two potential scenarios. Number one, continuation of London's move or reversal of the daily direction. If London moves in the direction of the daily bias, we can expect to see New York post a continuation of that move later in the day. Reversals require experience and insight to close before it happens. So we can see that there are two scenarios that could occur in the New York session, either a continuation of London move or a reversal. Here's an example of New York Killzone. So you can see this time window here, how price moved, rallied upwards. So you can see market was quiet. This is Euro USD 15 minutes. You can see how market was quiet from this point. This is the Asian session I told you. Majority of the time, you see consolidation in the Asian session for the European and British pound pair. That is the pair that are not paired with the Australian dollar, New Zealand dollar, and then the Japanese yen. So this line here depicts the 12 a.m. midnight New York time. So there was no any setup for the London Q zone. So if you don't see a setup in the London Q zone, expect to see it in the New York Q zone. And look at how price took out liquidity, protracted against the intended move before rallying upwards beautifully. And then finally, the ICT London close Q zone. So this is the time window. We have the 10 a.m. to 12 p.m. Eastern time. The London close is a particular time of the day that usually ends the opposite end of the daily range. Major pairs are ideal to trade in this time window. So just like the previous Q zone, that is the New York Q zone. Here again, we are seeing that the major pairs are ideal to trade in this time window. And the London close session offers about 20 to 30 pips. The London close usually posts a retracement of the high of the day on bullish days and of the low on bearish days. It depicts taking of profits for the day. London close sometimes also creates continuation points for swings. So we can see a whole lot of characteristics for the London close Q zone. You can use it for a retracement after the day was bullish. So usually set the end of the day. So if London posts the low of the day, you should expect to see London close Killzone to post the high of the day, and you can trade it for a retracement. If the day was bullish, you want to be trading the retracement. If the day was bearish, you want to trade the retracement here. And then another thing again we could also see from here is that major pairs are ideal to trade in this time window. And usually why you see a contrarian move against the move of the day is because that is where people are taking profit. So if the day was a buying day, London close will post a retracement into the range, because why? The trades that were taken for that day, many are taking their profit, which will show a retracement downwards. Another thing again is that day trade seeks liquidity. So you discover that that trading day, liquidity was taken. If it was a bullish trading day, liquidity was taken above the market. And if it was a bearish trading day, liquidity was taken below the market. So you want to see a retracement after liquidity was taken, and that depicts distribution by the market makers. So I hope we get this. All right. Now, another very important thing is that London close sometimes create continuation point for swings. So let's say you want to take a swing trade. Let's say market hits a key support level, and then you want to take a trade. You can go down to a lower time frame and then expect price to react. Let's say you want to buy. You want to be taking that buy trade from a London close. That day, market would have probably retraced down, because you want to see market retrace into the range of that trading day. So you are seeing market coming down into that support level to take a buy, and then the same for a sell. So I hope you understand. All right. So here's an example. You can see here, London formed the low of the day. And then this area, this time window here, we see market forming the high. So after market rallied upwards, there is a retracement into the range that was created. So you can be taking a trade in this time window. You can see how market formed the high beautifully here after taking liquidity above the market. So you can expect a retracement, taking of profit, distribution into this range that was created. All right. So now let's look at the anatomy of the trading day. This line here represents the beginning of a trading day using the GMT time zone. This line represents the 12 a.m. midnight New York time. And then this line represents the close, which is 5 p.m., the close of the trading day. We can see this line here. This line here represents the Asian session. This line here represents the London session. Here the New York session, and here the London close. And this line here, you can remember when I taught you protraction, I told you that the open of the market after this time zone, which is the GMT, expect protraction. Now you can remember the lesson on protraction. This line here is the GMT, the market open. This is actually the market open for a trading day, but we use the New York trading time, which is the 12 a.m. We use the market. I use the New York. You can use this one as well. I don't. You can use it. But I use this, I further refine it to the New York 12 a.m. So you can see how market protracted upwards against the intended move before running down for the Asian session. Then for the London, you can see how market came back down below the open of price. And you can also see here, this is the New York. So if you put, I didn't put it here, but here will represent the 7 a.m. And look how market protracted downwards before rallying upwards. But if you want to use the market open for the trading day, you can see how market opened here and then went below the market before rallying upwards. And then for the New York 12 a.m., look how market came down before rallying upwards. So implementing Killzone, you'll note that the area of maximum move and protraction occurred in the Killzone. So let me just point it out here. You can see the low formed here. You can see the low formed, the protraction formed here in the London Killzone. You can see another low formed here in the Asian Killzone. You can see this high formed here. Like I said before, you can use it for a retracement against a previous move of the day. You can see it formed here. So these points are where you want to be taking your trades. It gives precision to your trades. So you don't just come to the market and take a trade here. Look at this move here. It will take you out. Don't just come here and take your trade here because this is a New York trading session. Because why? Market sets a continuation for a buy for that trading day. Like I said before, New York does two things, either a reverse or a continuation. So you can see that the market is setting a continuation for a buy. Now let's look at what happened here. So market retraced down, took out liquidity, took out the Asian low, protracted against the intended move before rallying upwards to create relatively equal highs. Here, what would you see here? Here you will find liquidity, buy stops. So market retraced into the New York Killzone, finding support in this bullish order block that was created in the London Killzone, and then rallied to take out the liquidity which is above the market, the Asian high. After the market retraced again into this fair value gap, finding support in this bullish order block, and then rallied again to take out the liquidity above these highs. Now, you see how market retraced down into the range created in the London close. So you can see how each trading Killzone gave an opportunity for a buy and a sell, after which market consolidated for the rest of the day. So you want to be out of the trade 2 p.m. instant time. This is where the market dies down. You can see it here. If you trace it from here, so you can see how market died down here. All right, let's move on. Now you can see this candle here. Everything that happened here is only illustrating this candle. So this is a bearish candle. Now you can see the low, the high, the open here, because I explained before, this is actually the real open, but we use the New York. We don't use the market open. This is where market actually opened. Sorry, here, this place. So you can see market opened here, rallied upward. You can see this rally here. Then came back down. You can see this low that was formed. So you want to be buying below the open of the market. So you can see how market came back down, formed the low in the London session. So market forms low and highs in the London session for the European and British pound pairs, the European pairs. All right. So market rallied. You can see this huge rally. Went back up again to take out the liquidity which was formed before coming back down to close below the open. This is the open. So market closed below the open, making it a bearish candle. Let's look at another example again. So we can see the Q zones here, the Asian, the London, the New York, and the London close. We can see this line here. This line is the GMT, 0 GMT, and this line is the 12 a.m. New York time. You can see how market formed the ring, the Asian high and the Asian low. So market was quiet from this point to this point. So market created a protraction when in the London Q zone, and then went above the market open for the 0 GMT and also the 12 a.m. midnight New York time. So market went above the market open, taking out liquidity that was formed here before rallying downwards to clear out the liquidity below the market. The market retraced in the New York Q zone into this fair value gap to create a continuation for a bearish ride for the rest of the day. So we can see this candle here. This is the open, market protracted upwards. So this protraction here, we can see it happened where? In the London Q zone before market rallied downwards for the rest of the day. We're going to look at another example again. So this line here depicts the 0 GMT. This line here, the 12 a.m. midnight New York time. Asian Killzone, London Killzone, New York Killzone, and then London close Killzone. So you can see how market opened at this point. This is the market open, and then this is the market New York open. Now look at how price protected when in the London Killzone, taking out liquidity below the market and finding support in this bullish order block. I didn't want to point out here so that it doesn't affect the market open here. So we can see this bullish order block here. Market rallied, but the rally wasn't strong enough, so you could expect a continuation in the New York's Killzone, taking out liquidity above the market. You can see that liquidity was taken here above the market. So price took out liquidity before retracing down into what? This bullish breaker block. So here is a breaker block. I think I should point it out properly. So we can remember what a breaker block is. Market came down to take out liquidity before running to break structure to the upside and then retrace back down into this breaker block. So market found support in the breaker block when in the New York Q zone. So you could expect a rally here. You don't just expect market to move anywhere. You can see how market is moving in the Q zones. It's not just moving anyhow. So this is what we call time and price theory. The moment price got to this high, because you can assume that liquidity was taken at this point here, the chart wasn't big enough for me to show the liquidity that was taken here. So you can see how market retraced into the range of the day. Now, what is this? Fair value gap. So market has to come to fill it in. And then for the rest of the day, market ranged. All right. So this is the candle here for the trading day. You can see how market opened below. They opened here, then came back down. You can see this small protraction. So market protract against the intended move before rallying upwards to this point here, forming the high in the London close. So you can expect to sell this range because why? There'll be profit taking and liquidity has been taken here. So market makers want to distribute their trades. They want to be out of the trade for the trading day. You can see how market rally downward into the range. So I hope that this lecture was able to help you understand time and price theory, giving you precision as you take your trades in certain time windows. The Asian Killzone, the London Killzone, the New York Killzone, and then the London close Killzone. As all times, I wish you all good luck and good trading.